This brief talk will serve as an introduction to Chapter 9, Receivables. And as we've seen in the past, companies can make both cash sales and credit sales. Why would they make a credit sale? Well, businesses extend credit in order to make more sales. Makes it easier for the customer to get the goods before they have to pay. But a risk is created. Will the customer's promise to pay later be good? And because there's additional business risk, you introduce a new expense account called bad debt expense. And the question for this chapter is, when is that bad debt expense recognized in the books? The choices that exist on the timing of recognition of bad debt expense are: 1, wait. Wait until later when it's known which specific customer will not pay. Or estimate the bad debt expense now in advance. The wait method is called the direct write-off method in the book, and the estimate now is called the allowance method. The allowance method is generally accepted accounting principles. It's GAAP, and that properly presents expenses in the period in which they arise, because we're trying to match the bad debt expense with sales when they're recorded, rather than wait till later. Matching is not achieved. This is not GAAP. I want you to learn both methods, but know that it's the allowance method that achieves the GAAP objectives of recognizing bad debt expense so that it can be matched with sales, and a proper net income can be recognized each accounting period. Just to recap what's going on when a credit sale is made. Companies record a debit to accounts receivable, current asset, and record the sales. Sales appears on the income statement. That's a credit account. This is a current asset account, which eventually turn to cash. As receivables are collected, we'll credit receivables and debit cash. But the issue is in this chapter is that not all these promises by the customer will be paid when they're due. 30 days later, 60 days later, whatever the terms of the credit sales are. So the key in this chapter is recognizing bad debt expense a debit account in periods in which we make credit sales. We get a matching of expenses in the same period that we recognize the sales. As mentioned, the first method of waiting until we know the specific vendor, the direct method, that does not accomplish the objective of recognizing bad debt expense in periods that we're creating credit sales. But just to indicate how the direct method works, which I want you to know, it waits. It may be 6 months or even a year later that a certain receivable is written off, in which case, let's say one customer was $1,000. A part of this $100,000 was not was determined not to be collectible. The direct write-off method directly takes it out of accounts receivable and recognize the expense at that time. So it waits until this is known who the customer that is not paying. But the allowance method doesn't wait for that. The allowance method uses an allowance account, allows for bad debt or allowance for doubtful accounts. It'll establish that now and make an estimate. In the period of sales, there's going to be $900 that won't be collected. It reduces the receivable. The estimate is a credit. It reduces the receivable. At the same time, establishes the expense now rather than later. And then later, when a specific account is not known, then it's written off. Let's say it's $1,000, and it's taken against the allowance account that was previously estimated. The key, though, is that the allowance method allows the expense to be recorded now rather than later to match to sales in the current accounting period. Again, the allowance method is GAAP. That's the one that satisfies proper financial recording. Creating a new account, which is a contra asset account, comes under receivables and is deducted from receivables. So the two are netted. The debit in account receivable is netted against the credit in the allowance account. And when it's finally written off, that allowance account is reduced when the actual write-off occurs. So again, it's an allowance for doubtful accounts, sometimes called bad debt allowance in your book. That account is established, and you'll be established with a credit balance to allow a bad debt expense. Debit to be recorded now rather than later to match sales so that the income statement is properly stated. Again, this is a contra asset account established on an estimated basis, now rather than later. I want to emphasize that there are two stages to using the allowance account. The first stage is what I call when specific customers are not known who will not pay. So therefore, we'll do an estimate of bad debt expense. The second stage I call the actual stage, when a specific customer is known, and now we're going to remove them and write them off from the main account receivable asset account. Two separate stages to use in the allowance method. There's a handout in Momentum Contents which displays these two different stages, the estimate stage and the actual stage. The estimate stage is when the bad debt expense is recognized. We're going to debit bad debt expense and credit the allowance for doubtful accounts or allowance for bad debt expense. Again, a contra asset account. So here's the journal entry made in the now to recognize bad debt expense to be matched against credit sales of the period. Later, and this could be 6 months, a year later, whenever it's decided a specific account is going to be abandoned because the customer has declared bankruptcy or whatever, and an actual write-off will occur, the actual write-off removes the receivable from the main asset account, crediting account receivable, and now debiting the allowance account that was established in the estimate stage. Now, there may not be an exact, the estimates may not exactly equal the amount that's written off later. The point is, though, the allowance account is used to estimate the bad debt expense to record it now rather than later. Later, when a specific account is written off, it's taken out of receivables, it's reduced, and then a reduction occurs in the allowance account. Normally, a credit balance account, so we'll debit it to reduce it. In the second stage, the actual stage, where a specific receivable is known not to be collectible. Another handout momentum illustrates the estimate versus actual stage. Again, recording receivable credit sale, debiting the current asset account receivable, crediting sales, and then estimating bad debt expense for the period, debiting bad debt expense, and crediting the allowance for doubtful accounts on an estimated basis. Stage 1. Stage 2, later, and it could be 6 months or a year later, when the actual customer is known that will not pay, stage 2 will credit the receivable account and debit the allowance account that was established for that purpose. So over time, this will tend to be used up when actual write-offs occur and taken out of the accounts receivable account. But again, stage 1, estimate, the expense is established. The actual stage, the actual customer is known and taken out of the asset account, and the allowance account is reduced for that actual write-off of the customer that's deemed not collectible. This chart is a good one to keep in front of you when you read the chapter or do homework. The bottom of that chart, I described the 2 stages. Again, the estimate stage, a specific uncollectible receivable is not known, but the company is providing an estimate on collectability in the contra asset account and provides for bad debt expense in that stage. So we're going to credit the allowance account and debit bad debt expense in the estimate stage. Now this reduces net realizable assets. In effect, account receivable, the main asset, is reduced by the allowance account. So the net realizable to be collected is the net between the debit in the receivable and any credit at a point in time, credit balance in the allowance account. The actual stage, we know a specific customer will not pay. We're going to remove that from the asset account and remove it from the estimate account, the estimate amount which was established in the allowance account. Now, when an actual stage write-off occurs, note the following. The net realizable asset values are not affected. Why? Quick example, let's say our total receivables are $100,000 and at a point in time we have a $9,000 credit in our allowance account. So our net realizable asset shown on the balance sheet is $91,000. Debit minus credit equals net realizable receivable, debit. When a specific account is written off, when it's known, let's say it's $1,000, we'll remove $1,000 from the receivable account. We'll also remove it from the allowance account. The net asset change is 0, bringing over our net balance here, $99,000, $8,000 remaining, 91. The net realized amount has not changed by our write-off of the specific account. We remove it from the asset account, but we also remove it from the allowance account. The net realizable value doesn't change. This is strictly a balance sheet entry. Does not involve the income statement because assets do not change. Again, this is the second stage, the specific actual stage. When a specific customer is written off and it's taken out of the allowance account that was established previously for that purpose. Just to recap, the net realizable asset values are not affected in the actual stage when an actual write-off occurs. Actual write-off, remove it from the asset account, removed from the allowance account. Both of them go down, but the net amount does not change.